Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
So let's just double check. Most people are listening to this, and that's fine, I understand. Make sure the recording works. It does. Excellent. So we are in week 6, so mid-semester week. No mid-semester in this class. Thank you, Joseph. Right? Not in week 6. We do have an online exam, as I mentioned on a number of occasions, which will all be on Waddle. It will be in less than a month. In terms of the questions that I'll ask you, it's already stuff we discussed. So from this week, lecture 6, we're actually going to start on the material that you need for assignment number 2, so ratio analysis, right? Which is easier than discounted cash flow. It's easier than assignment number 1. Assignment number 2 is easier and quicker than assignment number 1, which is why it's worth less marks in the course. But your online test, which will be after the mid-semester break, details of which you can find in your course outline, will be all on Waddle. And the type of questions that you can expect, well, let's take a look at the practice question exam, and specifically the multiple choice. It's all going to be multiple choice, the online exam, and it's all going to be discounted cash flow based. So WACC, discounted cash flow. So what can you expect on the mid-semester exam? Well, you'll get an accounting statement that looks like this, maybe a very short income statement, very short balance sheet, maybe a very short cash flow statement like this, and some additional information that you need to answer the questions. Question number 1 is going to be, what's NOPLAT? Guaranteed. I'm telling you the question. See how nice I am? I'm going to ask you question number 1, calculate NOPLAT. If you think I'm not going to ask you that, you're crazy. All right? Question number 1, what's NOPLAT? Yeah, so, and using that information, the answers are also available, by the way. But I will say to the practice questions here, but I will say this, and I said this in my other class that I teach, my first year class, is when you practice for the online test, for any test in any course, if you go straight to the answers, that's not learning. That's just going to the answers, right? And I understand everybody wants the answers straight away, right? But guess what? The online test, your final in this course, in all your classes, you're not going to have the answers. You know, it shouldn't be a surprise to you. You're going to have to calculate the answers yourself. So when you're practicing for any test, including my test in this course, if you just go straight to the answers, what's NOPLAT? NOPLAT is... where is it? NOPLAT. So what does he want? He wants me to use this information. I understand, and he wants me to calculate NOPLAT. NOPLAT is here. Okay, this is NOPLAT. How do you get this? Okay, it's the sum of this. Okay, how do you get this? That's not learning. That's just going to the answers. What learning is, trying it without looking at the answers, making a mistake, and not making the same mistake again in your online test or your final. That's learning. Making a mistake when you're practicing is a good thing. It's what you want. Don't get frustrated when you're studying for the online test in my class or any class if you make a mistake while practicing. That's what you want. You should be happy when you make a mistake, because that means you don't make the mistake again in your final or in the online test, in this class, in any class. You shouldn't be frustrated. You should be happy when you make a mistake, when you're practicing. Because if you make that mistake when you're practicing, using this the online test I gave you here as an example, you won't make it again when you're actually, it's worth marks. When you practice, what I'm trying to say, when you're practicing and you go straight to the answers, guess what? You're not going to make a mistake because the answers are given to you. So that's wrong. You want to make a mistake when you're looking at the practice test. But when you just look at the answers, of course you're not going to make a mistake. They're just the answers. They're correct. So there's no learning process there. It's just going to the answers. And of course, I'm not going to give you the answers for the final or the online test. So the mistakes that you would be making if you did the practice exam correctly and not look at the answers are mistakes you're not going to make during practice. You're going to actually make it on the actual exam and lose marks. And you're going to get very upset at me, at yourself, whoever. But if you're upset, that doesn't matter. Nobody cares that you're upset. Your mark does not care if you're upset. Right? If you study incorrectly, it is your fault that you made those mistakes. It is not mine, it is yours. So please do it properly. Don't look at the answers straight away. Make the mistakes while practicing so you don't make them again. So the questions I'm going to ask you, like I said, question number 1, what's NOPLAT? If I'm asking you NOPLAT as question number 1, guess what question number 2 is going to be? What's free cash flow? Right? And then I'm going to ask you to calculate the WACC. And then I'm going to ask you to use the cash flow and the WACC to calculate a valuation. You need to know the continuing value formula, right, that I talked about last week. Once you have the continuing value formula, all the free cash flows, you can calculate discounted cash flow value for your company. All right, you can calculate the percentage change. This is a free question. You know, basically just calculate the percentage change. Then you're going to be asked how to calculate invested capital. And because ROIC is something that's very important, hopefully I've tried to teach you that in this course. In order to calculate ROIC, you need the invested capital. You need the NOPLAT in the numerator that you've calculated in question 1. And then in the denominator, you're going to be forced to calculate invested capital. When you have the NOPLAT and invested capital, you can calculate ROIC. I'm going to ask you to calculate ROIC in the online test. Right. You're going to be asked how to calculate capital turnover, right? You should know what that is. I'm not going to ask you these questions. This is this practice exam that's on Waddle is for the final exam. So this is stuff for the ratios, which we're about to start this week. So of course I'm not going to ask you that in the online test. I'm going to ask you that in the final. So these sorts of questions is what you need to expect and be able to calculate in the online test. All discounted cash flow related. Yeah. You need a calculator. You will not have Excel in the exam, so obviously I'm not going to ask you to estimate beta using 104 weekly returns. That would be crazy. I'm not crazy, not yet. Maybe in a few years, right? You never know. I'm not going to ask you stuff like that. I'll give you the beta. I assume I gave you the beta here. Yeah, there it is. But identifying cash flows, discounted them to time 0 is what discounted cash flow valuation is all about. So expect these type of questions in the online test. It's all multiple choice. It's all calculation. Yeah. Yes. I don't know. I think so. If it's not, I'll say something in week 7 on Monday. So in 3 weeks' time when we meet each other again. But I think it's all calculation. I wrote it in February, so it's a while ago. I'm getting old, you see. So I think it's all calculation, yeah. In the final, however, there'll be some theory questions as well. That's why I'm hesitating. Because in final, I wrote that already as well. There'll be some theory questions in the multiple choice section, right? Just like here, just like in the practice question, the practice exam, I think. There's calculation here, and then there's some theory questions here. So it's going to be like that in the final as well. In the mid-semester, unless I say something in week 7, it's all calculation, I'm pretty sure. Pretty sure. And here are the answers, by the way. Yeah. So it's all calculation and all based on discounted cash flows. All online on Waddle. Yeah. So please study for it and take it seriously. If you start studying for it the night before, you will not do well. Big surprise. It's after the mid-semester break, so you should have time to take it seriously. It might be redeemable, but I think from last semester, the best students who got high distinctions in this class from me all did the mid-semester. Well, it's not a mid-semester, it's an online test, and took it seriously and got good marks in the online test. All right. So if you're interested in a good mark in this course, you should take the, even though it's redeemable, you should take the exam, Waddle exam, seriously. Any questions on the online test? I might say something. I won't say. I gave you all the hints I'm going to give you. The type of questions you're going to be asked. I already gave you that 2 minutes ago. But I don't think there's anything else for me to say when we see each other in the lecture again in week 7. The online test is week 7, but the end of week 7. But on Monday, I'll see I'll see when we get there in 3 weeks' time. But in terms of the hints, I just gave you all the hints that I'm going to give you. Right? What sort of questions are you going to be asked? Any questions? Okay. It's stuff you've seen before. I'm not a mean guy. When it comes to tests, I'll always test you stuff that you've seen before. But if you don't study, don't expect miracles. Right? Don't expect to get a good mark. You won't. Because I'm the kind of lecturer who, when I write an exam for students, I always think, I can't make it too easy, but I don't make it too hard. But I make it so that people who studied are rewarded. And people who don't study, I cannot help you. You have to help yourself. Before I help you, you have to help yourself. So please take it seriously, even though it's redeemable. Because you never know with the final exam schedule how it's going to be. You might only have a couple of days to study for my course. For the online test, you have 2 weeks, right? So that's a long time. I'm not telling you study for 2 weeks. I think probably 4 days, maybe 3 days is enough. But you cannot do it in 1 day. Yeah, no chance. Okay, so today. So originally in week 6, we're not supposed to have a workshop, but I added an additional workshop just to help you with the assignment, which means that week 6 workshop will happen on Thursday, and I'm going to talk about the WAC inputs. Right? The notes are up already for workshop 6, so please attend. If you have a mid-semester, I understand. I'll have everything on. I'll use the document camera so everything's recorded. Okay, but today we're going to start on a completely different topic. We finished with discounted cash flow. That's assignment number 1. Today we're going to start on ratios, which is really assignment number 2. And we're going to be talking about 2 of the most famous or the most widely used, the most common ratios, and that's PE, which is by far the most popular. That's the very, very important ratio that you have to be familiar with. But the other one that's also popular is EVM, the enterprise value multiple. Both ratios are used every single day in practice in investment banks. Analysts use them to value companies. Before I get to the slides, a very easy way to think about ratio is everything collapses to a perpetuity. So what I mean by that is, remember in DCF, in discounted cash flow, and what KGW is asking you to do is you have 15 years times 0, 1, 2, all the way to 15. Well, there's a 10 here. This is in detail. The first 5 years that's phase 1. KGW calls that phase 1. And you need a lot of detail about forecasting growth, CapEx, depreciation, inventory, all those things. And then from 5 to year 15, KGW, that's called phase 2, as I showed you in your KGW model. Everything all the forecasting collapses to just 6 or 7 lines in KGW, which is here. The model calls it phase 2 in the forecast drivers. It's here, phase 2. And so all the forecasting for the 10 years is just done via 5 or 6 lines. And then for, So that's done here in KGW in the forecast drivers. It's called phase 2 here. So that's from 2024 to 2034. And then from then on, the KGW asks you to input a continuing value assumption, right, down here. So going back to this timeline here, so phase 1 in KGW, phase 2 from 5 to year 15, and then all the other cash flows until infinity, we use a continuing value or a perpetuity formula. It's the same thing. You want to call it a perpetuity, that's fine by me. It means the same thing. Perpetuity, continuing value, same thing. Ratios, what they essentially do, they jump to this straight away. They jump to a perpetuity straight away. That's essentially how they're based. So already everything collapses, no phase 1, no phase 2. There's still a valuation of cash flows, but they jump straight away to this continuing formula, which means one important thing. If your company, whatever company you're valuing, in our case JB Hi-Fi, is a mature, stable company, then the continuing value formula, ratios in other words, are not bad. They're actually pretty good as a methodology to use. But when you're valuing a young, growing company that's probably losing money in the beginning, so its earnings are negative currently and hopefully positive in the future, there's a lot of changes, it's buying, selling, firing, hiring, growing, shrinking, different projects, ratios are not the best because the company is not what we refer to as in steady state. It is not stable and sort of growing slowly and organically. JB Hi-Fi is. It is a mature business. There is no innovation. It is simply a retailer that buys for X and sells to you X plus margin. That's all it does. And its organic growth is through opening about 5 stores a year. All right? That's all it does. So for a company like JB Hi-Fi with very stable growth, organic, we cannot predict artificial growth. We cannot predict what they might do, another acquisition of some kind. They might, it's possible, but we cannot predict, and the company will never say that, well, in 3 years we plan to do another acquisition. First of all, they would never say that. And second of all, it would be very stupid if they said that, because the moment you say, I want to buy this, guess what happens to the price? It goes up, right? And if you're buying a house and you tell the real estate agent, I want this house, don't do that. Say, I don't want the house, I don't know, I'm not sure. That's what you should say. If you say, oh, this is the best thing I've seen, I have to buy this, guess what happens to the price you pay? It goes up, right? So don't do that. That's stupid. Yeah. And companies know this. They will not say, oh, in 2 years' time, we'll buy Harvey Norman or something like that. Company will never say that. They will always, their standard response to any, if you as an analyst or journalist ask them, what do you plan to do in terms of future acquisitions? The standard response for any company is, we're always open to new opportunities. All right, so it's all very vague and not definitive. They will not tell you what their plans are. Right? So with ratios, even if JB Hi-Fi, if your argument is, well, I understand it's stable and mature, but they just did good guys. What if they have another acquisition in a few years? It's possible. I'm not saying it's not. I cannot tell the future. But ratios are good despite that, because we just don't know what the company is going to do. Look, they did good guys. That's true. But before good guys, they didn't do anything. No acquisitions whatsoever. They just grew organically. Right? So they've been around for a long time. JB Hi-Fi is not a company that's new. They've been around for a couple of decades, and they did one acquisition. Right? So, and that sounds about right. Companies do not acquire other companies every day. They don't. In some industries, acquisitions are more common than others. That's true. In insurance, finance, IT, acquisitions, pharmaceutical industry, healthcare, acquisitions are more common. But in retail, acquisitions are not that common. Yeah. So ratio, what I'm trying to tell you is ratios, what I'm about to show you today, is actually a pretty good valuation method to use with a company like JB Hi-Fi. But it doesn't matter if you value other companies, P ratios or EBITDA or EVM ratios that I'll show you all today are very important. Yep.
How about the company is already entered a recession period rather than a mature company? And in recession, maybe he had continuous free cash flow is a negative number. So how should we do it?
That's a good question. So, so I talk about that in the lecture, but I'll answer your question now. So the question for those listening is, ratios assume, like I said, that everything is in perpetuity, the company is in steady state. So the question from the lady is, what if a company is currently losing money? Then means you have a negative cash flow, then you would have a negative ratio or something like that. There's no negative ratios. It's like dividing by zero. It's undefined. There's no such thing as a negative PE or anything like that. But what you do there is, if that's the scenario, and I talk about it in the lecture, you should not be using ratios. You should just be using DCF and just say the company is currently growing, or it's a young company, it's not in steady state, it's losing money. So I choose not to use ratios. So I just use DCF, and in fact, DCF is the best method to use in that situation. But if you still want to use ratios, you can. But then what you have to make a judgment call as an analyst is predict when the company is going to turn a corner and it's going to start approaching steady state, and then use the ratios based on that prediction, whether it's 2 years from today or 3 years. So your PE ratio will not be the current ratio or 1 year forward ratio. It's going to be a 3-year ratio, right? It's going to have a longer outlook. So your perpetuity formula, if you like, will not tell you where the stock price is currently, because it would be negative. There's no such thing as negative share prices. It will tell you, according to the ratio, where the stock price should be if the company turns around, doesn't go bankrupt, hopefully gets better in terms of performance, where it should be, 2-3 years from now. So, and that is, in fact, I'll talk about that in the lecture, there is a big limitation of ratios. It's correct. It is because everything collapses into a perpetuity. You cannot have a perpetuity of negative cash flows. You'll just get a negative share price. And there's no such thing as a negative share price. In that scenario, ratios shouldn't be used, is the right answer.
How about when we use the DCF model, how can we determine the terminal value of the company? Just based on the liquidation value, or we assume there will ongoing?
Yeah. So the question for those listening is, it's a very good question, sort of a question not for this class, it's maybe for lecture like 8 or something like that. How do you determine the value of a company that's currently losing money? Do you, as an analyst, just take the liquidation value, which is just a fancy word of saying, if I took all the assets that are on the balance sheet and sold them at market value, how much I would get for liquidating the company? That's liquidation value. Or should I, as an analyst, just assume that the company is going to turn around, or it might have some few bad years and then it's going to turn around, or it's never going to turn around, and just value the operations as is, and just then recommend a sale recommendation, I guess, to your clients? The answer to your question is, you would not use liquidation value until the company already plans to liquidate. Companies, or you as an analyst, expect the company to announce liquidation very soon. Or a different company has come along and said, we want to pay this much for a company that's losing money. Then liquidation value becomes important. When a company is either on the verge of bankruptcy, in bankruptcy, there's an offer from a larger or a different company wants to buy a company that's not doing well, then liquidation value should be calculated. Liquidation value should always be calculated if the company is either close to bankruptcy, and then when it's in bankruptcy, then all the assets are sold and the company is disbanded, it dies, doesn't exist anymore, or when the company is being sold. Because the alternative to any transaction, whether it's in bankruptcy court or selling the company to another company, is you can always say no as a shareholder. You own the company. You can vote to say no. I don't want to sell the company to somebody else. I just want all the assets to go to auction, be auctioned off and sold, and I get whatever's left as the shareholder. And that's liquidation value. So think of liquidation value as the alternative to selling yourself as a company to somebody else. And if, it rarely happens, but if your liquidation value is larger than when somebody else is offering to buy you, you should reject the transaction and just wind up the company, which is just a fancy word of saying kill the company and sell all the assets. If that doesn't happen, then as an analyst, if you're predicting the company to turn around, do well, maybe spend some money on CapEx or new products or new services, whatever it is, then you should take the standard DCF approach and just assume, forecast somewhere that, this team, new management team, usually when a company is losing money, they fire everybody, a new management team comes in, will turn the company around at, year 3, and then the company is going to do well. Or, as an analyst, if you're pessimistic, this company is dead, the competitors are much better, it doesn't matter what it does, doesn't matter who's CEO, the company's going to fail, value it as a failure. That's a sell recommendation to your customers, to your clients, if you're an analyst valuing a company, and tell them to stay away from it, sell all the stock, the usual, and say, essentially in your report, you would say, how much is the company worth in bankruptcy? That's what you would really answer the question. So liquidation value is very interesting. It's an interesting concept, but usually is reserved not for valuation of ordinary operation. It's just usually for either transactions or when the company is looking to die, and then all the individual assets are sold off to other companies or to auction, or there's a partial sale. With Lehman Brothers, if you follow the history of Lehman Brothers, Barclays was very close to buying the whole company. So when Bob Diamond went to New York in 2008 to talk to Dick Fuld, who was the CEO of Lehman Brothers, they already had an agreement in place. They were going to buy, Barclays was going to buy the whole of Lehman Brothers. And then the US government said, we cannot guarantee the transaction because Barclays is a UK company, not an American company. And the British regulator and the Chancellor of the Exchequer, which is just a fancy name for the Treasurer in the UK, said, we cannot approve the transaction. It's outside our law. So it killed the deal. But then what happened was Lehman went bankrupt. The company went into bankruptcy court, and Barclays bought 60% of the company, of the assets that they wanted. And then the other 40% were worthless, so nobody bought them. But Barclays bought part company. In a bankruptcy court, all gloves are off. Some companies can buy some of the assets, all the assets, whatever it is, right? And that's when liquidation value really becomes important. When the company is being sold, or there's some bidding war for the assets, because even a company like Lehman Brothers, some of the assets were valuable still. It was the CDOs, it was the collateralized debt that was toxic, right? That really, but as a business, some of the arms of the investment bank were still valuable. The wealth business was valuable. The market making business was valuable. It's just all the collateralized debt obligations, all the subprime mortgages that killed the company. Yeah. Because the way CDOs worked is it took about a month to sell a CDO. So you buy mortgages as a bank, thousands of them, you pool them together into a security, into tranches of risk, and you sell the tranches to investors. But it takes about a month to do that, which means during the month, if you buy all this stuff for $1 billion, and in a month's time that billion is worthless, it's actually worth zero, then you're broke, right? Because banks are highly leveraged. They're 90% leveraged. So even if you're a $10 billion company, if you're 90% leveraged, if you use 1 million, you're bankrupt, right? So that's exactly what happened. Yeah, that's why the bankruptcy was so quick. Generally companies in practice, they take years to die. Bear Stearns died in a week and a half. Lehman Brothers died in 2 weeks, right? So, because they've got so much debt on the balance sheet. Okay, so let's start. Let's have a look here. So the ratios today. Ratios or multiple-based valuations, it means the same thing. It is a valuation method that is very important, and analysts use it every day. But because everything is sort of collapsed or shrunk to a perpetuity, the perpetuity the cash flows that you are discounting should be in steady state, should be maintainable is the word that's used in textbooks and is the correct word. So something that's in sustainable, steady state, maintainable, whatever you want to call it. There can be growth. Remember, there's that little G. Even in KGW, you can have long-term growth in your continuing value formula. Right? You can have a little G. Yeah. But the growth is steady, right? It's linear. It has to be in steady state, which is why, like the question said, good question, was that for losing companies or companies in bankruptcy or companies going through a lot of change, ratio is really not the right method to use. But for JB Hi-Fi, it is actually very appropriate. So we're going to talk about PE. PE is the best out of all of them by far. It's the most popular. In every single report, you will find a PE ratio. The reports I gave you for JB Hi-Fi from JP Morgan, they will all have a PE ratio calculation somewhere. The other one that's the second most important is enterprise value by far. Enterprise value multiple, EVM, it all means the same thing. The other one's cash flow multiple, not that popular anymore. We'll talk about it, but it's not the best. Dividend yield, the problem there is just a yield, it's just a percentage. It doesn't give you a share price. All of these give you a share price. Price to sales is a very silly ratio. Maybe in the 50s it was popular. Now it's not very good because it's even too simple. And I'm going to talk about what's required for assignment number 2. So first, these ratios. The reason why assignment number 2 is worth less than assignment number 1, because ratios are very easy to use. You're just multiplying 2 numbers. It is very easy, very simple, very quick. That's because the ratios themselves are very simple, they're intuitive, they're very popular, and they're easy to use. Right? That's a big advantage. When time is limited, time is always against us. When you have something quick, simple, and easy to use, then that's a big advantage. The other advantage is in DCF, generally you have to forecast 10, 5, 15 years like KGW, and then a perpetuity. In ratios, you technically only need 1 year. You don't even need 2 or 3. Analysts usually provide 1 or 2, but as it says here, the main focus is just 1 year, because you only need one number. You only need the numerator, which is the sustainable or maintainable cash flow. So technically, you only need 1 year of forecasting, not 15 years like in assignment number 1. And the third advantage is ratios do work. They may be simple and stupid. Well, it's not stupid, simple and quick, but they do work. They're not as accurate as DCF, but they're pretty good. And they work with respect to the actual returns, something that investors are interested in. Your clients, you're an analyst, you're recommending to buy and sell stocks. When you buy and recommend, you should recommend to buy low PE stocks. When you do that, on average, using historical returns, actual data, you do outperform high PE stocks. So a low PE is a buy signal, is what I'm trying to say. There is a negative correlation between the returns on an investment and a low PE. Right? So the idea is with the PE ratio, the lower it is, the cheaper a stock is. So you should buy it. Because PE ratio, one thing you should, before I get to the slide and an explanation, think of PE ratio as this way. The numerator is price per share of the stock. Current price per share. So for JB Hi-Fi, that's what, $26 or something like that. The denominator is earnings per share. 1 year into the future, so at the end of the next financial year. So for you guys, that's 30th of June 2019. Per share. Per share, per share. They're both per share measures. Price per share currently, earnings per share in the future. So you have the current price here and the earnings on the denominator. What the PE ratio actually is, if that's the case, and it is, what the PE ratio essentially is the price you pay for earnings. You're buying, as an investor, a lot of people make the assumption, the correct assumption that they're buying a piece of the company when you buy stock. That's true. You are becoming a part shareholder of the company. But what you're also doing, and these investors don't do enough of this, and they should, when you're buying a piece of the company, you're also buying earnings in the company. Yeah? You're buying earnings. And the cheaper you pay for $1 of earnings, the better deal you're getting. You have to spend less for $1. Because $1 earned in Harvey Norman is the same as $1 earned in JB Hi-Fi, same as $1 earned in BHP, $1 earned in Rio Tinto, $1 earned in whatever, Cochlear, COH, a great company in Australia. Money is all the same. It has the same color. The $50 bills, they're all the same. They're all the same pictures of the same dead people, right? $100 bills, $5 bills, $10 bills, $20 bills. It doesn't matter if they come from my wallet or from JB Hi-Fi, they're all the same. So if that's the case, if money is the same, then you, when you're buying earnings as an investor, you want the best deal. You want to pay the least for that $1, for those $20 bills or $100 bills or $1 million bill, or whatever, right? And that's what P ratio shows you. It shows you how much you're paying, the P, per dollar of earnings in the denominator. So the lower this is, the better deal you're getting. The less you're paying for that $1. Right? And investors don't think enough like that they're actually buying earnings. They think they're just buying a company or part of the company. And that's true, but you're also buying a cash flow stream. And whether that cash flow is in dividends or capital gains, it doesn't matter. Dollar is a dollar, right? So what's the disadvantage? And it's not just the PE, they all work the same. EVM, you're buying, how much are you paying for EBITDA? Instead of EPS, which is really profit after tax, this is NPAT, net profit after tax. EBITDA ratio or EVM ratio works on EBITDA. So how much operating profit are you buying? Right? Same thing. Disadvantage of ratio is that they are, they're not flexible. And that's the problem there. So with DCF, the nice thing about a discounted cash flow approach is you can specifically say what your growth is in year 2019, 3%, 2.8% in sales, 2.1%, minus 1.1%, minus 0.8%. It's all flexible. You can have specific inputs for each year for things like revenue growth, costs, inventory, working capital, operating cash, CapEx. You are in control as an analyst of your assumptions. And if the company, if you're forecasting some kind of a increase in leases, you can forecast that easily, right? You can increase that here. Or if you think the company is going to increase its dividend payout ratio from currently, like it said, 65, that's here, 65, and you think, oh, the company is going to increase that from 65 to 70 in 2020, or 75 or 80, whatever you want, for whatever reason, DCF gives you that flexibility. It is a very flexible approach. You're in control of all the cash flows as an analyst. Ratios, because everything again is shrunk into a perpetuity, you essentially have control over the cash flow, one cash flow that's projected forever, the G, the growth, and the discount rate. That's it. So there's only three or four inputs, and here there is, thousands of inputs that you can choose from, right? So it's a lot more flexible. All right. The next thing is for a stable, mature company, calculating maintainable or sustainable or steady state earnings is not that difficult because it's very close to current earnings. For a company that is, again, going through growth, it's shrinking, it's losing money, whatever it is, trying to estimate what maintainable earnings are because they're so different from current earnings is very hard and can be very vague and subjective. The appropriate multiple is also not always available. It's not available when the company is losing money because if the company is losing money, this E is negative. If the E is negative, the whole ratio is negative. There's no such thing as negative PE. They don't exist, so it's undefined. So P is between 0 and infinity, theoretically, but we'll talk about the ranges of the P's on slide whatever 10. But usually for companies that are going through change, young companies losing companies losing money, the P ratio or any other ratio that I'll talk about today are not available. Yeah. As I said, in that case, for these non-earning or growth companies, you really don't have a choice. You have to use discounted cash flow. Yep.
So the earnings we used will be, the normal case will be the current year earnings?
1 year forward, so 1 year in 2019 for you guys. So very good question for those listening. The earnings that we're using here in this P ratio, this denominator, this E, is it current? No, it's not. The P is current, the current share price. The E is 1 year forward, so the next year's earnings. So for you guys, that's 30th of June 2019 with JB Hi-Fi. So the end of the next financial year, in other words.
So in the case of the younger companies, it will differ like 2 years?
Correct, which is what the lady was asking behind you, yeah. So if you want to use a ratio for a company that is going through change, not losing money currently, and you still want to use the ratio, you probably shouldn't use it, but if you really want to, if your boss is forcing you to use it, then the E here in the denominator has to be year 5, year 6, year 3, whenever the company reaches a more stable situation. Yeah. Yeah, that's right. Yeah, excellent. So it's in the slides. So there's not just one PE. The P that I've been talking about is the forward P, which is the ratio that analysts focus on the most. It's the most important P. But correct, there are different types of Ps. The question you're asking about is the trailing P, which is where the current share price and the current earnings. But as an analyst, the one that and that exists, it's fine. It's just backward looking. That's the downside. The earnings are backward looking, and if the maintainable earnings and the current earnings are the same or very, very similar, then the trailing P and the forward P will basically be the same number. Yeah, and no problem, use both. They're identical. So if this one is 12, this one will be maybe 12.2, so very close. But as analysts, because we want to, it's a forecasting exercise in this course, and as an analyst, generally the forward P is more important than the trailing P. But again, if it's a sustainable business, it's stable, it's steady, it's mature, no problems, everything's growing nice and steady, a linear way, maybe 2-3% growth, something like JB Hi-Fi, then the trailing and the forward P will be very close. And then I'll talk about later, I'll talk about the relative P as well. That's also another type of P. So there are essentially 3 types of PEs. And there's a few others that are not important, like a takeover PE. Then there's a transaction PE, historical takeover PE, industry PE. Yeah, there's all basically, and when you hear the word PE, and this is what I want you to do, like I said 5 minutes ago, it's just the price you pay for earnings. And the higher the PE, the more you're paying. The higher the PE, the less likelihood of you recommending to buy this stock. The higher the PE in a transaction, the less likely you should recommend for the company to sell itself or sell its asset to another company. The higher, it's just the price in supermarket, right? When you go to a supermarket, you see all those prices. When something is too high, you walk away. Same thing here. If the PE ratio is too high, if you're paying too much for earnings, you should walk away. Yeah, same thing. So P ratios were the dominant ratio, the dominant valuation method in the past, before computers. Before computers, if you go back to Ben Graham, who invented valuation in the 50s, you can read his book. Benjamin Graham's book is very good. He invented valuation, the idea of a fundamental value. That's all terms that come from him and his book. When he did that in the 50s, there were no computers, right? Personal computers, at least. There was a computer, that looked probably the size of this room, one computer that was less powerful than your phone. But as analysts, we didn't have access to computers. When we didn't have access to computers, guess what? We cannot have a 15-year discounted cash flow model that allow you to input estimates for CapEx or WACC or something like that. Analysts used to use these ratios. This was the dominant valuation method a long time ago. Now with computers and with spreadsheets and Excel, it's not the case anymore, but they're still useful, right? As it says there, they have become less dominant over time, but still widely used, right? and they're used to supplement the primary valuation technique, which is DCF. Right? So they're the second best, if you like, valuation method. Because, I'll say it again, this is very important, because everything is shrunk, condensed into a perpetuity, essentially, we need to use maintainable earnings. We need to use earnings the company can generate in perpetuity, forever. And yes, that's true, nothing's forever, except death and taxes. That's true. But we have to assume, just like we assume with the life of a company, that it goes on forever. We have to, as analysts, close our eyes, well, hopefully not close our eyes, think and forecast a level of earnings the company can do forever. Right? Because that's how perpetuity works. You get that one cash flow forever. And what that means is anything abnormal, any special one-off items have to be subtracted from any earnings estimate. In order to be maintainable, any one-offs have to be subtracted or ignored, stripped out, whatever you want to call it. Yeah? Because, again, we're reducing the whole valuation process that you guys are currently doing in assignment number 1 into a single formula, into a single perpetuity. So maintainable earnings with fixed or no growth prospects is actually what we need. Yeah. So the reasons why you cannot just use current earnings, I know it's easier, it would be easier, I understand. It would be easier just to use the current earnings. Right? You don't have to do any modification. It's available, you know what it was. The company just reported their results a couple of weeks ago, right, JB Hi-Fi. That's nice, that's convenient, but just because it's convenient and quick and easy doesn't mean you can just use the current reported earnings or the earnings reported a couple of weeks ago for JB Hi-Fi. Because again, you have to use maintainable earnings, something that can happen forever. So with JB Hi-Fi, this is not a big problem because the company is, I mean, their earnings would be, so this is a good one. If I was teaching this class last year they acquired Good Guys. And they didn't have Good Guys for the whole 12 months. They only had it for, I think, 9 months. Which means the earnings would be artificially small because it's missing 3 months of earnings from Good Guys. So we as analysts would have to increase in one of these adjustments that we make, we go from reported to maintainable, we would have to increase the reported earnings for those 3 months that the company never, 3 months of Good Guys sales and profit that the company never received, which would be horrible. Luckily for us, the 2018 results already have the full year of Good Guys sales. So the amount of adjustments we have to make to Good Guys is to JB Hi-Fi, sorry, is not that bad. But if it wasn't, if this course was, I was teaching it and we were valuing JB Hi-Fi, it would be a lot more difficult and subjective. So reasons why reported earnings and maintainable earnings, what I'm trying to tell you is it's not on this list, but what if the company acquired, like JB Hi-Fi, acquired Good Guys, and in the reported earnings, they only had 9 months, not 12 months, a year is 12 months, they only had 9 months of profit on the income statement for that company. That would be a problem. That means reported earnings would be below maintainable earnings, and we cannot use reported earnings. We would have to adjust reported earnings in order to get to maintainable earnings. Okay, so that's one reason. The other reasons is any one-offs, anything abnormal, anything that's not sustainable. Again, perpetuity means forever. If the company is buying or selling assets, they don't do that every year. Right? If there is some revaluation of a pension account, wouldn't happen in Australia because we have superannuation, but in the US, a lot of companies still save money for their employees, which is wrong. They shouldn't do that. There's a big conflict of interest there. You should have private saving accounts. You should be able to control your money, not just close your eyes and say, oh, I work here, I trust you, I'll give you all my retirement money. Bad idea, right? You cannot trust anybody, especially when it comes to money, right? That's a fact, right? So any sort of revaluations, goodwill write-offs, if they're very large, for JB Hi-Fi, if there is any goodwill write-off, it's very, very small, it's tiny, and usually most of it is because of a foreign exchange thing. So it's not a big problem. Redundancy cost, if you're firing a lot of people, that's expensive. It's expensive to fire people. So hopefully you won't be firing people every single year because you're structuring your company. You have to restructure your company every single year. So any of these one-off significant items, I had a consultation today with the team asking me about Clive Anthony's, and a big significant item because of that New Zealand business being closed down and rebranded into JB Hi-Fi stores. And the question from the team was, can I put it in significant items? Yes. So if those costs were in reported earnings for Clive Anthony, I don't remember what year it was. It wouldn't be in 2018, obviously, it was whatever when they did that significant item. It did appear on the income statement for that year. It would be included in the reported earnings, but it's a one-off. So when we go from reported to maintainable, we would have to subtract that cost, right? So, and you subtract the cost by adding to the profit, right? So everything has to be reversed. So if the one-off is an expense, you have to add the money back. If the one-off is an additional revenue, you have to subtract it. So you reverse the transaction. By stripping it out, that's what analysts call it. Stripping out means taking it away. You take it away by reversing the transaction. So if it's a one-off expense, like a redundancy or a significant item because of Clive Anthony, then you would add the money back, right? And therefore increase your profit. Your maintainable earnings would be higher than your reported earnings if that was your only adjustment. If the Clive Anthony significant item was the only one, then your maintainable earnings would be higher. Other ones, cash, goodwill amortization, any impairment charges. If there are any for 2018, then yes, you would have to adjust for them. For JB Hi-Fi, remember they do have sometimes they can be large as well. So if there are the case for 2018, you do need to adjust for them. Especially if you forecasted anything, remember we have to use 2019 earnings. So if you forecasted what students do, and analysts do this as well, they look at the company amortizing its goodwill or doing any impairment for its intangible assets, and they just take the historical average of what it is. If you did that, that's fine. But if you have any intangible impairment charges or goodwill amortization for 2019, you have to subtract them. You have to reverse that cost. You have to add them back, right? So if you forecasted for 2019 an impairment of goodwill for, let's say, $1 million, that's a cost, $1 million, you have to add that back to your earnings. You have to add back the million. Make sure it's after tax, right? So the reported earnings that we'll be using NPAT, net profit after tax, or NOPLAT, that's all after tax. So a common mistake here that students make, and in exams as well, in the final, I mean, because this is all going to be in the final as well, is that the cost is given to you before tax, let's say $1 million, but you're adjusting profit is after tax, so your adjustment has to be after tax as well. You don't just, if the cost is 1 million, you say, oh, Joseph, I remember you have to adjust for it. Don't add back the million. Add back the after tax amount. Add back the million multiplied by 1 minus the tax rate. So all your adjustments have to be after tax, because usually all these costs are given to you on the income statement before tax. And what you're adjusting, reported earnings here, is after tax. So your adjustments have to be after tax as well. So whatever the cost is, make sure to remember to think, oh crap, do I have to multiply it by 1 minus the tax rate? The answer to that question is usually yes. All right, so everything has to be after tax because the reported and the maintainable earnings are all after tax as well. Yep.
Some of the companies have regular impairments.
Have what impairment?
Regular, I mean.
Yep. Correct. So good question. So for those listening, the question is, what if the company that you're valuing has impairment every single year? If it has it every single year, then it's not a one-off adjustment, and you don't need to do this for that company, right? If it's every single year, if it's a consistent impairment, if it's not a one-off, in other words, if the company is, for whatever reason, firing people every single year, and companies, so what's a good example? Company that's constantly firing people would be some kind of a sales-driven business. some kind of a company that's based on sales, especially in the US. Real estate? No, real estates are not publicly listed. Company that's firing a lot of people every single year. I don't know, maybe manufacturing, some kind of a manufacturing company. If they fired people every single year because they just have a high staff turnover for whatever reason, then this redundancy cost is not one-off, it's every single year, so you don't have to adjust for it. I think that's worrying if the company has to fire people every single year. Because, you know, if people get fired, that's normal, that's part of business. But if a large portion of your staff have to be fired every single year, and these are high, yeah, that's not a good sign, right? Companies that are going through constant staff turnover are generally in trouble. Generally, they are not good places to work because you want to retain that talent. It takes time to learn how to do a job properly. Right? You cannot just walk into any company and know everything, right? So if you're constantly firing a lot of people, then you've got to train those people again, right? Over and over and over again. That's expensive. So that's a bad sign if you have large redundancy costs. But if you did, for whatever reason, then to answer your question, yeah, it's not a one-off. You don't have to adjust for that. Yeah. Same with R&D. So this sort of answers the question, R&D or exploration. Imagine you are a mining company or a pharmaceutical company. Well, if you're a pharmaceutical company, your research and development costs are very high every single year. If you're a mining company, your exploration prospecting costs are high every single year because that's just your business. That's what you do. You look for gold or copper or iron or zinc or nickel or copper, whatever it is, every single year. So your exploration costs are persistent. And if you're a research and development company, IT company, if you're a pharmaceutical company, you're developing some kind of medicine, your research and development costs are going to be very high every single year. So they're going to be persistent, so you do not adjust for them. But if they're lumpy, if they're one-off, if they happen once every 10 years, then they are one-off and they need to be adjusted for when you go from reported to maintainable. So if it's lumpy, you do need to normalize or strip it out or offset or adjust, whatever you want to call it. It all means the same thing. This is important usually for companies, tax rate. Also unsustainable interest rate. So those are quite commonly adjusted for by analysts. Tax rate is, it's an interesting one. Usually when a company is losing a lot of money, we talked about this before, the company then accumulates a lot of DTA, a lot of deferred tax assets, and then once it becomes profitable, it uses the deferred tax assets to lower its tax, but it can't do that forever. Probably can only do that for 3 or 4 years. So you need to say, okay, it's only paying, in this reported earnings, which is after tax, it paid very little tax. It had a high profit, but paid very little tax because they used a lot of deferred tax assets. That's unsustainable. When it's unsustainable, you have to adjust for it. And then you as an analyst have to say, okay, the long-term, the stable, the maintainable tax rate is not 10%, it's actually 30 or 25%. And the tax in your earnings has to be based on the 25 or 30%, not on the 10%. Yeah? Same thing with these days, especially unsustainable interest rates. Whether you like it or not, interest rates these days are very low, all over the world. In my mind, unsustainable. Interest rates, the Reserve Bank governor in Australia already said interest rates are not going down, ever. They're only going up, right? Because they're already at very low levels. Low interest rates, why it's good for business, it's very dangerous because everybody just gets a lot of debt, picks up a lot of debt on the balance sheet, and then interest rates starts going up because of inflation. They have to go up when inflation goes up just to fight the effects of inflation. And then you're left as a company or as an individual with so much debt on your balance sheet that it's unsustainable. And then you can head into bankruptcy. This is why I said, you know, the Sydney and Melbourne real estate markets, dangerous, very dangerous. I understand the price has gone up a lot. But I think I've said this before, or maybe in my other class. We've had no wage growth since the financial crisis. Zero. Zero wage growth in Australia after inflation. No real wage growth from 2009 to 2018. In the same time, prices in Sydney have gone up 2.5 times. They doubled in Melbourne, which means the growth of that asset is not asset at all. It's just debt. So guess what happens when interest rates start going up and households in Australia, which are the most indebted households in the world, the household debt to GDP ratio is 120%. The next closest is US at 80, right? Which means Australians are 50% more in debt than anybody else in the world. Guess what happens to real estate prices in Melbourne and Sydney? Fire sale time. Right? But, you know, I guess that's my point of view. But you can look at the data. The data does not lie. Here, when you're normalizing and you look at it as an analyst and see your interest rates that you're currently losing, and this applies to JB Hi-Fi as well, the interest rate that you're using, and we use it specifically in the cost of debt, like I said in lecture 4, will go up. It's unsustainably low. It will go up at least 1%, 1.5% to a sustainable number, right? So if you want, and what does that mean for earnings? Well, guess what's in earnings? Interest expense, right? Interest expense, interest costs, whatever your finance costs, whatever JB Hi-Fi calls it on the income statement, is included in the reported earnings, in NPAT. That will increase. Currently, they set it on the balance sheet, 3%, right? Between 3 and 3.15% is their interest rate cost. That will go up to 5%, right? So if you, as an analyst, know that, what you can do is you can take the debt they have on the balance sheet, the borrowings, instead of multiplying it by 3% to get the interest expense, multiply it by 5% and get a much higher interest expense, and then include that in your maintainable earnings calculation. So what I want to see from you guys is at least an acknowledgement, even if you don't agree with me, you're wrong, by the way, because interest rates will go up. The Reserve Bank governor said it himself. You should at least acknowledge that we just assume that interest rates stay the same, which is a bad assumption. I cannot tell the future, that's true, but interest rates will go up. So one of your adjustments going from reported to maintainable earning calculation for JB Hi-Fi should be a correction for interest expense going up, because current levels are not sustainable. They're not maintainable, they're not long-term, they're not in steady state. Interest expense is too low, much too low, artificially low, because the governments around the world, the central banks, are trying to stimulate the economy, right? The economy is weak. It is. There's no efficiency, there's no growth in innovation or productivity is the word that I'm looking for. So all the growth is artificial. It's just low debt, which is dangerous. It's easy growth. It's like population growth. It's very easy to grow an economy when money's free or cheap. But that's not how you grow a business sustainably. You grow it by innovation. Efficiency increases. Productivity increases. That's how you grow a business forever, right? Growing a business by borrowing is very short term. Maybe 1 year, 2 year, 3 year, okay. Right? And I think I put an article up about the debt supercycle on Waddle. Right? Easy way, very easy way to grow an economy, to grow a world economy or any company even, is by debt. But at some point, did I put it? I didn't put it here. I put it in my other class. Here, the debt supercycle. So this is an interesting article from Macquarie Bank that I can provide to you. So where did that save? Show in folder. Go to this class. I can add it. It's a fascinating article. It's not examinable or anything like that, but it sort of talks about what I'm talking about. It's wrong. What I'm trying to talk to you about, that debt and the cheapness of debt is just unsustainable. We're in a fantasy land in our economy. We are. This growth is all fiction. It's all artificial. It's not real growth. Back. It's all debt fueled. It's easy to debt super cycle. Now, anyone can just borrow money. It's not that difficult. It's just a contract, right? But at some point, you have to pay it back, and people are just ignoring that, which is a shame. Wrong one. Yeah, so have a read, and sort of talks about the dangers of debt and cheap debt. And currently, we have a lot of cheap debt. 3%, JB Hi-Fi, that's crazy. That's free money. My mortgage was 3.87%. That's insane. That's insane. To borrow, I borrowed $750,000 at not even 4%. That's insane. That's crazy. That's so cheap. Right? And it's all artificial. It's all non-sustainable. It's all fake. Yeah. Okay. So another thing we have to adjust for, so this definitely impacts us. For JB Hi-Fi, you don't really have to play games with the DTA or DTL. Yeah, you don't need to, because we just don't know how a company's going to use it. The only company we valued in this course that had a massive DTA, massive, I think it was $600 million, was Coca-Cola. Yeah, so JB Hi-Fi's DTA is actually very small, so you don't have to do any adjustments here. Earnings differing from trend levels. Again, if a company is going through a change, or maybe it's a very cyclical company, it's growing with the economy, and if we're not at sustainable levels, then you need to adjust to a trend. So from current levels to a trend or a long-term level based on where the economy is. The economy is just a cycle. Probably something you've seen a lot before. The economy grows like this. Long-term growth in the economy is a linear line that goes like this, but we go through cycles, peaks and troughs as the GDP. And JB Hi-Fi is a cyclical stock. It grows with the economy. So if you think we're like somewhere here or here or here, and you think it's sustainable, then no problem. But if you think we're here or we're here somewhere and we're going to go up, then you need to adjust for the fact that we're currently very depressed in terms of growth, and we're going to go up. In my opinion, where are we? I don't know, somewhere here maybe. So I don't think you need to really worry about adjusting for cycle for JB Hi-Fi. It is subjective, that's true, but long-term growth prospects look good for Australia. It's just we have too much debt. That's the only problem I see, really. Yeah. But sometimes you're not there in the cycle. You're sometimes at the bottom or at the very top, and things look very good at the top. But when you're at the top, there's only one place to go. Ooh, that's the problem with the top, right? Yeah. Then also any investments the company makes usually doesn't make investments every single year. I mean, they only bought Good Guys. They're not going to buy Good Guys again. It was a big investment, but it's a one-off as well. Luckily, again, it would be in the 2017 numbers, not in the 2018 or the 2019 numbers, so we're all good there. Lazy assets just means underperforming assets. Some companies have a lot of assets that are not currently operating at their full capacity. So you as an analyst have to make a judgment call saying, okay, this factory is only operating at 70%, the company's doing well, it's only a matter of time before it operates at 100%, right? So lazy assets, so the laziness or the underperformance is only temporary, and you would have to adjust for that to that new level. Or you think we're currently operating too much at 110% and it's only going to go down. So Tesla, for example, would be a company that's operating at above 100% capacity. And this is, you can look this up on Google, I'm not lying, it sounds crazy, but they're manufacturing cars in tents. In a tent. Actual tent, not a building. And as problems go, that's a good one to have. There's such high demand for your cars that you don't have room on the factory floor. Some of the production has to be temporary, made in temporary accommodation, because you cannot build the building fast enough. As far as problems go, that's a good one, right? You just have so much demand for your product that you just cannot meet the demand in your current structure. And Tesla is expanding. The Gigafactory is the largest building in, it's bigger than the Boeing building, which was the largest building in America, but it's not the biggest building in America. I don't know what it is. It's maybe number 2 or 3, the Gigafactory in Nevada, near Las Vegas, where they build all the batteries. I think it's like the third or the fourth largest building in the US. For a long time, it used to be the Boeing building, the airplane company. They used to have the largest building in America for a long time. But as problems go, that's a good one to have, right? You have so much demand that you can't build them fast enough. They're projecting the assets are overperforming, and that's just not sustainable. It's not sustainable to build cars in a tent, right? So you as an analyst have to say, okay, hopefully they finish the building, and that this project of building cars in a tent is shut down, right? A last thing is long-term growth. Like the LTG, the long-term growth, analysts call it LTG in the forecasting, is, again, sustainable growth. In a perpetuity, what's the G? Many companies don't have a G. The G is 0, right? Because they cannot in forever deliver growth. There are some companies that can. There are companies, JB Hi-Fi is not one of them. JB Hi-Fi is not a company that can grow at a G above 0 forever. It just doesn't do anything. If it did something, okay, but it doesn't do anything. Companies like Cochlear, right? ASX code COH, eBay, these companies can grow on forever. They really can. They're fascinating companies to value and study. Fascinating companies, Cochlear. These companies can grow on forever. They really can. Whoa, share price has gone up. Whoa. I shouldn't have sold it. Why did I sell it? I sold it here somewhere. Oh, man. Shit. See? I sold it too early. That's not good. Oh, I lost a bunch of money. That's okay. Another guy, CSL is a great company that can grow on forever. These research, whoa, that's gone up as well. Whoa. I didn't have the stock, so I'm fine there. But Cochlear, I had quite a bit. Yeah, I mean, these companies they're very good companies. They're well run, good products, good services. Healthcare spending in Australia is going up. We have an aging population. A lot of old people that are living until they're 90, 100 years old is normal now. Imagine that 40 years ago. 40 years ago, living past 65 was, wow, you were very healthy. Now 90 is standard, which means demands for these sort of products is just going to go through the roof, right? And these companies are benefiting. If you do a good product as a company, you develop some new drug or some kind of new medicine, healthcare is where it is. Healthcare has a good future in Australia in terms of a business, right? And as you can see, the stock market does. I mean, stock and valuation are two different things, like I said, but yeah, these companies are doing well. Well, look at that, currently at the 52-week high. Yeah. Why did I sell Cochlear? Not good. bad decision, right? Right. So with perpetuities, we have to reduce everything to maintainable earnings, right? So a few specific ones. This is just what you need to look out for as an analyst. What are the typical ones you need to adjust for? For us, for JB Hi-Fi, this is something I would expect. Take a look at the goodwill amortization. If you have it every single year, okay. If you don't, you might need to adjust for it. There's no R&D, no explanation. Any one-offs, there was a lot in 2017. I didn't see too many in 2018. Just look at the income statement. I didn't see any from memory. Let's have a look just in case. 2018. Let's look at the balance, the income statement. So this is 2017, correct? Nothing in 2019. It's tiny. The other income. Sales is pretty good. I don't see anything artificial here. We're not in 2017, so no problem there. No. Okay. So, abnormal tax, you can know trend. I think they're currently at trend. They don't have any lazy assets, no new projects, it's just a retailer, no new investments. The growth of the company is at population rate. So there's no artificial growth like Cochlea or CSL. JB Hi-Fi is a boring company. So same sort of slide, just specifics. So things you need to adjust for, strip out, it means the same thing. Goodwill, pension adjustments, loss or sale on an asset, asset revaluation, tax rates, one-off items, all have to be adjusted for. That's always, almost always, other than like the question from the floor was from the lady, if there's goodwill amortization every single year, then no, you don't adjust for that. Other ones that are potential is any earnings that are currently from long-term or trend or maintainable levels. Underperforming assets, R&D and exploration if it's a one-off, and any unrecognized share of income in associates. If you have shares in other companies that sometimes pay a dividend, sometimes not, that sort of stuff I've seen before. Some non-operating assets, so joint ventures again. Joint ventures usually are for a limited time, like a bond, sort of 5 years, 10 years, maybe it's not forever, it's not maintainable. So when a company has a joint venture, usually that joint venture has an end date. And if it has an end date, it's not forever, it's not in perpetuity. So you need to adjust for that as well. So if there's an income coming from that, you have to subtract that income after tax from any maintainable earnings. Okay, let's look at the ratio. Okay, let's have a look. Okay, so the ratio is not complicated. It's just two numbers. It's just the perpetuity. Right? So the PE ratio, like I said in the beginning of class, is price per share, current price per share, divided by earnings per share 1 year into the future. Yeah, T plus 1. So 1 year into the future doesn't mean calendar year, it means the financial year. So up until the earnings for the next financial year, when the financial year ends. So for you guys, that's 30th of June 2019. Right? So even though we're in August, let's say end of August, you don't look at the earnings at the end of August 2019. There are no earnings at August 2019. The company doesn't report earnings on a monthly level. It reports it on a 6-monthly or an annual level. So even if you wanted the earnings from now until August 2019, that data is just not available. Right? So it's to the end of the next financial year. T plus 1 doesn't mean 12 months. It means until the end of the current financial year. So current financial year is FY19, which goes from the 1st of July 2018 to 30th of June 2019. So your T plus 1 is 30th of June 2019. Yeah. So once you have the P ratio, the calculation of the share price, which is what you want, like a DCF, you always want the price per share, is simply the P ratio multiplied by the earnings per share for your company. This P ratio is usually, in practice, the industry average. It's not the company's PE ratio. The reason why it's not the company's PE ratio, if you use the company's PE ratio, these earnings are the same. The EPS in the denominator here and the EPS here are the same number, so you just get back the current share price. That's stupid. So the P is usually an industry average. And the EPS is the JB Hi-Fi EPS for the 30th of June 2019. I give you all that data for the second assignment, so don't worry about that. I give you P ratios for JB Hi-Fi, Harvey Norman, Best Buy. For the second assignment already, you don't need to use this now, obviously, focus on the first assignment. But for the second assignment, just like for the first assignment, you will have a data file, which is currently located here. And for the multiples, if you open it up, you will have PE ratios, both trailing and forward PE ratios for your company. So this is the trailing PE right here, but we're more interested as analysts in the forward PE ratio here. For JB Hi-Fi, Harvey Norman, Meyer, TGA, Dixon's, Conn's, Amazon, Best Buy, Yamada, all these global companies. And it doesn't matter if they're not Australian. The reason why it doesn't matter is remember P is a ratio. If the price per share is in American dollars, then the earnings per share is going to be in American dollars. And the currency effect cancels. If this is in Japanese yen, the stock price, you're talking about Yamada, which is a big retailer in Japan, divided by earnings per share for Yamada, for that company. It's also in Japanese yen, cancels out. Right? So an American company or an Australian company or a Japanese company or a Korean company or a European company, and so the earnings are in euros, it doesn't matter. With ratios, the nice thing about it is you can take a global point of view because all these ratios are without a currency. Currency cancels out. The numerator and the denominator are in the same currency, so the effect of that currency cancels out, which is nice. That means we can use any company, as if it's in the same industry, it's similar to whatever company we're valuing, JB Hi-Fi in our case, we can take the P ratio of them to calculate this average PE. So this average PE is not just 1 or 2 or 3 companies, it's, I give you data, I think, for 10 companies, right? So, yeah. And the earnings per share will be for JB Hi-Fi. So here's the proof that the P ratio is just a perpetuity. It is actually, as it says there, shorthand, a capitalized version of a DCF model. So a DCF model has a cash flow stream that's discounted all to time 0. Perpetuity is the same thing. It has a cash flow stream, all discounted to time 0. So the cash flow stream is capitalized, or cash flows are turned into capital. That's what capitalizing means, just like in a DCF. And a good way to show this is the price for a stock is equal to the earnings divided by a discount rate plus any growth. PVGO is present value of growth opportunities. So E is just the current earnings. Maintainable earnings, sorry, not the current. PVGO is just future growth. Divide by E to get P ratio here on the left-hand side is equal to 1 over WACC, or cost of some discount rate, plus PVGO divided by E. And E, don't think of it as current earnings. Again, it's very important to think of E as maintainable earnings. Right. So the P ratio is just, and this is what you did in DCF, right? You had a bunch of earnings here in the numerator for 15 years, and then a perpetuity. Now you've jumped straight into the perpetuity, E over K, where E is that maintainable earnings per share number, and K is just a WACC. And then any growth, if you want, is PVGO, or you can remember modify the perpetuity formula to have that long-term growth, right? So the perpetuity formula that you've probably seen in your introductory finance subject looks something like this. It was used for the shares, right? And or it was right. So this is the version that we're using. This is E here in the numerator, and this is K in that slide, which is just WACC. And D is not dividend. E is maintainable earnings. It's the same thing. It's just a perpetuity. Yeah. All right. If you want to go from the dividend discount model that you've seen in 1001 or 7006, the introductory finance course, as you can see, here's the proof, if you like. The Gordon Growth model, or the dividend discount model, which is this, invented by Gordon Growth in 52 maybe? 50, I think 52, is equal to the present value of a dividend that's paid next, D1, divided by arm K minus G. So K is the discount rate, G is the long-term growth. The D can be restated into just the earnings times 1 minus the retention rate. The portion of earnings that are paid out as dividends is the portion of earnings that is not retained, right? So D is just equal to E times the payout. This is 1 minus rate is just the payout ratio. So in JB Hi-Fi's case, that's 65%. Right, so 65% of your earnings is paid out as dividends here. And down below, the G can be restated as, and your textbook does this, and it's actually, it makes sense, it's just very simple, that the G is just the retention ratio times the return on investment, ROIC, or technically it should be, it shouldn't be ROIC, it should be RONIC, a return on a new invested capital. Yeah. Flip it around again to get the P ratio on the left-hand side. All you're left with is 1 minus the retention ratio, so the payout ratio, in other words, divided by K minus the retention ratio times RONIC, return on investment. If the company is only able to invest in projects in perpetuity at the cost, at the WACC, which JB Hi-Fi is an example of a company that is not able to grow above its WACC over the long term, it can just grow at population, basically, then the P ratio actually becomes very, very simple. You can argue either way. I mean, you can have a valid argument that's saying JB Hi-Fi can maybe grow slightly above the cost, and that makes sense. But again, it doesn't matter if you have return on investment equal to the cost. This also shows you that it's very related to the PE rate, to DCF. It's just a very shorthand summary, shortcut of a discounted cash flow approach, right? And these formulas show you that. Very important slide. If you get this slide, then you get the ratios. So the P ratio, and all the ratios are based on this. I'll talk about the P ratio, but they all work like this. They have fundamental determinants. That is, the determinants that calculate what the ratio is and whether it's going up or down. If you like, in forecasting, we talked about growth drivers, value drivers, what drives the valuation, DCF valuation of a company. Here, these three determinants determine the value of a company with respect to the ratios, in terms of the ratios. And that is, the three determinants are the discount rate, the growth potential, and the earnings quality. And the earnings quality is a term, that's not the E, by the way, here. Earnings quality means something else. But as you can see those drivers here. There is an E here, there's a K here, that's the cost, that's the discount rate, and PVGO is the growth. All right, so let's go to this slide. So the three determinants of any ratio, here it's in the context of PE, but any ratio is the discount rate, the growth, and the quality of the earnings. First, the discount rate, the easy one. Remember, the cost of capital from lecture 4 is just a proxy for funding risk that is accounted for using the beta, cost of debt, cost of equity, and the level of gearing, the debt to equity ratio. The lower the cost, the higher the ratio. And that makes sense. The lower the K, the higher the PE ratio. It's not complicated. Next, growth potential. Company that has more growth potential, the ability to grow in the future or grow in perpetuity, is going to have a higher ratio. You as an investor will be asked to pay more for the earnings of that company if you want to invest in that company. The PE will be higher. Yeah? And that makes sense. This one doesn't make sense straight away, but bear with me. The earnings quality. The earnings quality, I'm not talking about the E here. That's just maintainable earnings. The earnings quality is the gap, the difference between what's current or reported and what's sustainable. Right? If a company is able to generate sustainable earnings due to a competitive advantage, for example, the good management team, whatever the reason is, it should be able to maintain prolonged economic profit leading to higher valuation. So a company that has a bigger gap where maintainable is above reported will do better, will have a higher PE ratio. You as an investor will have to pay more for those earnings. A lot of companies like that are like Tesla, in my opinion. I mean, it's just an opinion, where current earnings are okay, they're just breaking even, but their maintainable earnings, especially with the different businesses you think of Tesla, it's not just the cars. The roof tiles are revolutionary. The Tesla Powerwall is revolutionary as well. Imagine not being connected to the electricity grid. You can actually have a house without an electricity bill. All the power is generated from the roof, and during the night, when there's no sun, it's all stored in a battery. That's very efficient. That's great. You can have a power plant on your roof. Right? It's revolutionary, that idea. Right? And it's not the panels, it's actually, Tesla has a product where it's integrated. The shingles are integrated into the wall. I know I use Tesla a lot, but I actually read up on the company. So if you go to the company's website and you click on energy, nice cars. It's a nice car. It's a very nice car. Click on energy, And so these panels are gone. What you have is a solar roof, and it's all integrated. It's all in the roof. The panels, the solar panels are in the roof. So you can have it textured, you can have it smooth, I like the Tuscan, and you can have it in slate. And there are panels inside that. And then any battery, any energy that's generated during the day is stored in a Tesla Powerwall, which looks like this. Right? And no nasty panels. Oh, that's a nice car. The X is nice. Look, the S is nice, the X is nice. They're nice cars, right? That's nice, right? The X is nice as well. Revolutionary products, right? And they can't build them fast enough. So in my opinion, the reported earnings for Tesla are here, and maintainable earnings are somewhere here. So that company will have a high PE ratio, even though it's breaking even though the E, the current E, is very small, is basically zero, profit after tax, right? So, yeah. So to summarize, a PE premium, so a PE premium that is above some kind of a competitor or some kind of a market PE, we'll talk about market PEs in a sec, should be paid for. So a higher PE should be paid for a company that has a lower discount rate, that obviously has higher growth opportunities, so it has access to a lot of ROIC higher than WACC projects, and it has higher earnings quality, which means its maintainable earnings are significantly higher about its current earnings. So a lot of companies like startups usually have loss-making businesses in the beginning. They have high expenses, they have low revenues, especially in the beginning of their life. And hopefully that product or service that they're coming up with and selling will be a success. And then all their revenue and earnings will come in the future and forever, right, in perpetuity. Yeah. So a very important slide. If you get this slide, you sort of get where the ratios come from and what moves a ratio. So what moves a ratio, like PE, is this goes down, or growth opportunities go up, or this gap. It's not the E, this is not the gap. The gap between earnings and maintainable and reported is very high, it grows. Historical ranges. So ratios, the benefit of ratios is we have a range. We have a historical range, and these ranges are important and they work, right? So PE ratios can be thought of as, again, a price paid for a share in the company's earnings. And that's important. Think of it that way. I mean, you can think of shares any way you like, and it is a piece of the company, but again, not enough investors think of it as you're buying earnings, you're buying cash flow, right? And it doesn't have to be a dividend. It can be capital gains, the stock price going up, like my Cochlea investment. Not good. Sold too early, right? And a higher PE ratio means that investors are paying more for each dollar of income. So a stock is more expensive than one with a lower PE. The higher the PE, the more you're paying for something. And same with a supermarket, right? You walk into a supermarket, if the price was $5 yesterday, and now you look at it and it's $10, you walk away. It's too expensive. So same thing with earnings. You can use these PE ratios to say, ooh, that's too expensive. I walk away, right? And the higher the PE, the more expensive stocks are. So it can be interpreted as a number also. It can be interpreted as a payback period. It can be interpreted as the number of years of earnings which would be required to pay back the price for the shares. So if PE ratio is 10, let's say, so 10 divided by 1, that means the PE ratio is 10. So you're paying $10 for 1 year or for $1 of earnings each year. To pay that back, that's 10 years. So the PE ratio, if you want an alternative sort of explanation for the PE ratio, is the payback period, right? So if it's let's say 15, you have to wait 15 years, so you pay $15 for $1 of earnings forever, right? So to get back your $15 that you paid, you have to wait 15 years. So that's why, and again, the lower the PE, the better. If your PE is 5 or 7, you only have to wait 7 years. Of course, the shorter the better, right? You want to get your money back as soon as possible, and then everything you make after is profit, So the lower the PE, the cheaper the stock. So you can think of it also as a payback period, if you like, ratio. Payback period is probably something you saw in corporate finance. Yeah, same thing. It ignores time value of money. It's very simple. It's stupid, but yeah, P ratio is a payback period. So let's look at these ranges. So historically, these historical ranges is what P ratios, where they sit, right? Historical P valuation ranges give you these following situations. So first of all, when you have an NA, when you have a company that's losing money, usually its earnings, E, is negative, or you as an analyst think that the company is never going to be a success, so the maintainable earning is negative. There's no such thing as a negative PE, so your P is undefined, NA. A company with no earnings has an undefined P ratio, and obviously the valuation is useless, the ratio analysis. Next, a ratio between 0 and 10. Between 0 and 10, these are your cheaper stocks that think, ooh, very nice, very cheap. Not necessarily. Either, if it's between 0 and 10, either the stock is undervalued, so it's a good investment opportunity, or the company's earnings are thought to be in decline. Alternatively, current earnings may be sustainably above historical trends, or the company may have profited from selling some assets. So just because the P is low doesn't mean automatically you recommend a buy of the stock. Don't do that. There could be a reason why it's low. And so you have to check the reasons. Is it because current earnings are very, very high and they're going to go down? It's possible. A lot of companies suffer from that. Or the company sold a lot of assets, right? So its stock price is high because it sold a bunch of assets, but its earnings potential is the other way around. Its earning potential has gone down because they sold a bunch of assets, so those assets are no longer in the company to generate an income. But if none of that is true, if none of those are true, then it could be just because it's a good deal. I mean, it's cheap and probably a buy recommendation on the stock. If the company's PE is between 10 and 17, it's considered to be at fair value. That's the historical sort of average range for fair value. If it's 17 to 25, it starts getting a little bit high. It can be high because the stock is overvalued, so the P in the ratio is too high. All the company's earnings have increased since the last earnings figure was published, so its maintainable is going up. No, that's not right. Overvalue, that's fine. That's the numerator. Company's earnings have increased since the last earnings figure was published. If they've increased, or it could be an artificial, I have to restate that. That's not 100% clear.
The expectation of the company is to do that.
Correct, yeah. But then the E should be higher, and it should lead to a lower PE. So I'll change that. That is not very clear. I think I know what I'm trying to say, but it's not clear. So if the stock may be a growth stock with earnings expected to increase sustainably in the future. So the E is very low. That's why the P ratio is so high. So the denominator is very low. Yeah, that's also possible, right? So again, as an analyst, just because you see a high PE, oh, it's too expensive, walk away. Not necessarily. There could be there's usually a reason why it's so high. Either because the company is a growth stock and its earnings are currently very, very low, so its maintainable earnings are suppressed, but they will be hopefully in the future go up. Or the stock is just overvalued. Everybody's buying it. Stock's price is determined by supply and demand. So if everybody's buying a stock, the P is too high, the ratio is high. And next, when the ratio is 25 or above, get nervous, be very nervous, right? That is not good. P ratio of 25 and above is considered to be a speculation, sort of a bubble level territory. So with P ratio above 25, that's 25-year payback period. That's huge. A company whose shares have a very high P may be high expected future growth. Yeah, it's possible, so everybody's buying the stock. Or the company may be subject to a speculative bubble. So P ratios above 25 get very nervous. It's usually a big reason why. So if we go, just before I ask, yeah, just give me a sec. Before I go, let's look at the P ratios that I gave you. As you can see, the P ratio for JB Hi-Fi is very low. And for the retailers, I mean, that's crazy, 104. Could be Amazon, a big surprise. Amazon is killing it, right? Amazon is really a company that's killing it, doing really well. It's also an indication not to buy the stock, right? Because they've been doing really well. Everybody's buying the stock, and the earnings haven't caught up. So the PE ratio is way too high. So about 100 PE, not good. Right? It means it's really expensive. I mean, you can buy whatever you want as an investor, of course, but as an analyst, if I see a PE ratio of 100, I'm paying $100 for $1 of earnings. It's crazy. That is way too much. So, or the payback period is 100 years. That's a human lifetime, right? Question in the back? When you're calculating the average, you mean, or something like that. So you can, so up to you, just like with the beta, you can just take the most recent observations. I'll update these, by the way. I'll run the file again. So you can take just a cross-section of the current, most current. If you want to do a historical and then average of an average, you can. So what do we got here? So we got the acquisition here. And there was a big drop because they bought a mature company and then sort of recovered. Look, I would take sort of, there's no rule to answer your question of how many, if you want a historical PE ratio. Analysts generally just take the most recent observation for the industry average, which the average would not include JB Hi-Fi. So it would be average of all those companies, not including JB Hi-Fi. But if you want a historical, if you want an average of an average, so go to the time series. I don't know, there's no rule. I've seen 1 year, I've seen 2 years. I don't know, I wouldn't do that. You can, maybe a couple years of data. Don't go crazy. Don't go all the way back to, what did I give you the data, 2003. That's way too long ago. Maybe a couple of years, maybe 2, 3, maybe. If you want a historical average like this, average would be 13. Yeah, that's okay. Yeah. Okay. So we've got these ranges, and these ranges are based on historical information, but they're global. They're not for JB Hi-Fi. They're for all PE ratios. So all the PE ratio history for all companies have been used to come up with these ranges. And they're quite wide. 7 is pretty wide, 8. But again, with JB Hi-Fi sort of currently being around 11, 12, it sort of seems like fair value, which makes sense to me. Okay, let's get to this example, then we'll finish up. Okay, so the PE ratios I give you. You don't have to calculate them in any way. I give you the trailing. As I said, the trailing is the historical PE. Trailing historical means the same thing. And that PE is the actual price divided by actual earnings. And then I give you the forward, the actual price divided by the next year's 1 year forward, so 2019 forecast for earnings per share. And then the relative PE. The relative PE is the PE divided by another PE. So PE relative to some kind of a benchmark. And the benchmark is usually the market portfolio. Okay? And I gave you, so in the file, that I'll talk about more in the workshop, of course, not this week, but when we come back, I gave you PE ratios. These are the forward PE ratios, like it says there. These are the trailing PE ratios here. And the market PE to calculate relative PE are here. So the 1 year forward market ratios I gave you for, I was able to download some European retail index PE. I gave it to you for the Australian market. Again, I'll talk more about this in the workshop. So the PE ratio, coming up with the PE ratio will not be a problem. I gave you that information. What you will have to do, and this will probably be the most challenging part of the assignment, which is not challenging at all, to be honest, is coming up with the EPS for JB Hi-Fi for the next year. Things you need to consider for the earnings per share is the earnings for which are maintainable. That's true. But you also need to adjust for any new issues. And usually there's a couple of million of shares issued every single year. And dilution. And dilution is any non-equity claims that is not debt. That's right. So any equity-based claims, which are things like convertible bonds, JB Hi-Fi does not have any. Preference shares, convertible preference shares, JB Hi-Fi does not have any. Any warrants, JB Hi-Fi I don't think has any. Employee options, bingo, bingo, bingo. JB Hi-Fi does have options. Right. So what do we have to do? So the general philosophy for any issues is to use time weighting. I'll show you what that looks like. So it's not value weighting, it's time weighting. And then so that's for the issuance. For number 2, dilution, the general philosophy for dilution is the numerator is the equity earnings, so it's the earnings, adjusted for the impact of any conversion of these options that JB Hi-Fi has. What that means, and it says here, e.g., for example, after-tax interest savings once convertible bonds or convertible options, whatever, are converted, or the dollars received on any exercised options that are in the money. And the denominator, that's the numerator of the EPS, and the denominator is the number of shares after the conversion. So you're probably confused by this. What do I mean by that? Think of it this way. These options that JB Hi-Fi has, which are disclosed in the annual statement, are not issued at strike price of 0. They do have a strike price. The company is short in call options. The party that's short in call options receives the strike price, and the long position gets the shares. So the CEO, the CFO, the CIO, the people holding these shares get the share, and in return they actually pay the company when these options are exercised, a strike price, which is usually very much smaller than the current stock price, which is why they do it. The options are in the money. Now, that is money that the company receives. What is the company going to do with that money? We don't know. They never tell us, of course. But we as analysts have to assume that the money is used for something. What analysts incorrectly, but there's no other choice, assume is the money gets used to reduce interest expense. In other words, the money gets used to reduce debt, which is incorrect. But we don't, again, the company doesn't tell us, so that's what we do. And analysts do this in practice as well. I did it at Credit Suisse. We assume the money is used to reduce debt. When debt goes down, so we've got a balance sheet here. Let's say the debt is, I don't know, 600 million. There's interest paid on the 600 million. 600 million times the 3% gives you the interest expense every year. Let's say the company gets $100 million from the options being exercised. Well, this debt will go down from 600 to next year 500. At 3%, the interest expense will go down as well. And it will go down by the reduction in this debt, which is $100 million, which is the money the company gets from the options being exercised, multiplied by the 3%. And then what the slide says here, it's also multiplied by 1 minus the tax rate, because the earnings that we're estimating are after tax. So that's why all of the adjustments, that's why I said all the normalization adjustments have to be after tax as well, because the earnings that we're adjusting are also after tax. In the EPS, the numerator is net income, which is net income after tax. So let's look at this example for context, and then I'll finish. Here it is. So we start here. Let's say reported earnings for 2018. This would be 2019 and 2020 for you guys. So in your assignment, yep. Oh, sorry. Good. In your assignment, so this is my example for the week. In this assignment, in the first tab, it has this EPS estimation. This is what you have to do for your assignment. And it's a standard practice among analysts to estimate it for the 2018 for 1 year. A means actual, the actual earnings. And then for 2 years, this would be 2019 for you guys, what it says 2012 here in the example. F means forecast, and 2020. So do it for 3 years. 1 of that actually happened, and 2 forecasted. And you need to do that as well. Don't just do it for 2019. Yes, you only need it for 2019, but you want to see how stable it is from 2019 to 2020 to check the maintainability. What we have here is we start with the net income or profit after tax, whatever you want to call it. And then we have normalization adjustments. These adjustments to get from reported to maintainable or normalized. They all means the same thing. Here we have some kind of insurance recovery. What that means is the company